We are heading for a blistering stock rally over the past 3 weeks. This week, we're on pace to close up 2%. So, all clear? Should we get excited? Is everything okay now? Welcome back to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. As ever, if you are watching on YouTube, jump in the comments, share your thoughts about what we're discussing here. Keep it civil, as ever, and we'll incorporate your thoughts into the show. The question that we ask ourselves today is, how much follow-through does all of this optimism have? And what we'll do is first, we'll qualify where the optimism comes from. We'll take a look at why exactly this is so remarkable, what we're watching here. And next, have a look at why it is that the markets like it and what it is that comes next. Because, of course, the question, as ever, is, well, we've had a good 3 weeks. Are we going to have another good year to follow? Or is this a flash in the pan kind of thing? So, as you can probably tell from the title here, it's probably not a good idea to get too comfortable. And we begin our conversation here with just an assessment of what's going on so far. So if we just really quickly benchmark the 3 weeks that we're looking at right now, that would be this right here. These 3 weeks amount to about a 9% rise in the benchmark S&P 500. That's, of course, if we're on pace to finish somewhere near current levels. Could be more, could be a little bit less. To put that in context, that's the biggest rise since back here, June of 2020 or so. So we're talking about the biggest increase since the depths of COVID, since the rebound from the absolute deepest parts of the COVID downturn. And needless to say, that's quite the emphatic performance. So why are the markets so incredibly cheery? What is it that's having them move with such strong conviction so far in November? Because indeed, this is a story of November. Well, simply enough, it's the Fed. We can see here from the Fed meeting on November the 1st through to now, there has been a pointedly dovish shift in policy expectations. We got it first with the Fed announcement. There was a bit of a digestive pause last week. The momentum in stocks pointedly slowed. And then this week we got a CPI number that was a bit softer than expected, and that gave us disinflation in all the right areas, namely core services. So the markets are, not surprisingly, shifting Fed policy expectations into a more dovish direction and cheering the turn. So we can see from what's going on in overall expectations. At this point, there's about an 82% chance that we get the first cut in May. And by the way, there are no hikes left on this docket. Nobody is even considering the possibility that there might be any more tightening. It's been fully priced out. As I say, 82% chance of a cut by May. That cut fully baked in June. And when we look toward the end of the year, we're looking at 3 cuts and a 90% chance, 89.9% chance, let's round it. I think we're safe there, of a 4th. So really what we're looking at is a full 100 basis points almost in easing next year. If we want to get really, really, really detailed, we can say 98 basis points. So, needless to say, we are looking at quite a lot of easing and more easing than we expected even after the Fed announcement. So if we go back here, we can see with the Fed announcement, there was already a little bit of a shift, but it's even more now in the wake of CPI. So at the start of this week, the cut was maybe June, certainly July, and 75 basis points in easing. Now it's maybe May, certainly June, and 100 basis points in easing. So there's been a pointed turn. How have markets responded? Can we tell that it's the Fed that's doing this? Well, of course we can. So if we take a look here at the way that markets have been responding to evolving policy expectations, we can see this with relative ease. From the middle of the year, we've had a pointed reduction in rate cut expectations, essentially as the markets concluded that the SVB-led banking crisis and the first part of this year's budgetary debacle would not need aggressive Fed stimulus to be offset because they would ultimately not end up being major market-wide contagion events. And so we can see here that already at the beginning of the year, we were looking at about 1.75% in easing that's baked in between December of this year and December of next. And it gets worked down perpetually here. So as we become increasingly convinced that these issues are contained, fewer and fewer rate cuts over that period are expected, and stocks come down. Once that seems to peak, once that process seems to end, and we roll over in the direction of, again, more cuts, here, stocks find a bottom, and they rally. So here is the peak in rate cut expectations coming down. Here is where it rolls over. Is it any wonder that this is where stocks bottom and start rallying? Doesn't seem to be. And of course, it makes intuitive sense why this would be the case. Overwhelmingly, the US dollar is the quintessential currency of global commerce. Nearly 90%, according to the Bank of International Settlements, of global monetary transactions are settled in dollars. That doesn't surprise. U.S. financial markets are head and shoulders larger. Most global commodities are priced in dollars on global markets. And the quintessential engine for settling global monetary transactions is SWIFT, a dollar-based system. So it's really no wonder that the US dollar is the quintessential global currency, and all of this conversation about de-dollarization is, frankly, utter nonsense. So when the Fed raises the cost of borrowing dollars, or is thought to be raising it more in the future, that obviously implies higher borrowing costs on economic activity writ large. And isn't good news for stocks because it makes financing earnings that much more expensive. When the prospect of easing becomes more acute, when the markets start to look ahead to lower cost of capital, this process goes the other way. We can see the same thing in the US dollar. By way of confirmation, as we get fewer rate cuts that are baked in, the dollar strengthens. Its yield advantage strengthens because Of course, one person's cost of borrowing is another person's lending income. And so owning dollars in an environment where borrowing those dollars is more expensive is a more lucrative proposition. There is more interest paid on borrowed dollars in that environment. And so what you end up with is a situation where the dollar rises while this is getting smaller. And as it again rolls over right here, the dollar rolls over with it. So this is basically where we've been for the past 3 or so weeks, maybe a little bit longer. So where to next? Does this optimism have room for follow through? Well, maybe it does, but it is worthwhile to remember why it is that the Fed feels itself done, seemingly, with raising interest rates. It isn't because the economy is humming along. It isn't because economic growth conditions are rosy and supportive. Because, of course, all of those things would be inflationary, and the Fed wouldn't be stopping. If things are, in fact, good, we would not be getting a dovish turn in policy. So why are we getting a dovish turn in policy? It's because things aren't good. Next week, we are going to get an updated set of global PMI numbers for November. So it's worthwhile to say where they are as of October going into those releases. And what we can see here is that as of October, the global economy has stopped. So, as ever in the logic of PMIs, 50 is neutral, above 50 is expansion, below is contraction. We can see the composite index here, taking in both manufacturing and services, is at 50, which means the global economy as of October is neither growing nor shrinking. It has stalled. The service sector, which is by far the largest part, is still eking out modest growth, and manufacturing continues to shrink. In fact, the pace of contraction actually accelerated some in October. This is not uniquely a story for one kind of economy or another. Developed markets are doing marginally worse. You can see here there is already contraction here. So we're sub 50 across all indices, and the U.S. is still marginally growing. It's the Eurozone and the U.K. that really are giving us this push into contraction territory. Emerging markets are doing a tad bit better, but they're doing the worst that they've done basically since the beginning of the year. Again, near standstill, 51.1. Manufacturing has stalled. Services have weakened to levels unseen since the start of the year. The composite index has been going nowhere but down since peaking in May. So we're looking at a situation where, of course, global central banks are throwing in the towel. The Fed, of course, chief among them. But no major central bank, barring the Bank of Japan, is at this point expected to raise rates next year. And the Bank of Japan is certainly a special case. They completely avoided all the rate hikes that everybody else did since 2021, 2022, and are now expected over the course of the next year to bring rates out of negative territory to a big quarter percentage point on the target rate. So this is hardly the kind of deviation from the norm that we should be caring about. As for the other major central banks, absolutely nobody is expected to hike next year. And between the US, Canada, the UK, and the Eurozone, we're looking at an average of about 300 basis points in easing. More in some, less in others. So clearly, This turn in policy is occurring because the global economy is suffering. So, how much more do we have to go in this process of being happy that the medicine is coming before we return to the fact of why we're happy that the medicine is coming? And that is because the global economy is terribly sick. Now, markets, as ever, are forward-looking. So what we have here is a global surprise index from Citigroup, and it tells us how things are performing relative to forecasts to give us a sense of whether the markets feel things are getting worse, because that's really the key. It's not so much that they're bad, that much the markets can price in and move on with buying risky assets. It's more, are things getting worse? And really, since July, things had been getting better. That doesn't mean that, as we saw just moments ago in the PMI data, growth was improving. It wasn't. It's just expectations had been pulled down to such levels that realized outcomes were having an easier time beating them. So analysts were looking for even more dire conditions and didn't get them. Things weren't good, but they weren't worse. And that perhaps helps to set up the optimism that we're looking at now. But as we can see more recently, right over here, this may be starting to turn again and to head lower. So perhaps the stock of surprises on the upside has run out at this point, and so we are working on borrowed time when we look at this stocks rally. It probably has a little bit more room to run, if only because there's not an immediate catalyst standing in its way. We certainly have the possibility for a little bit more of a fillip, as a matter of fact, with FOMC minutes next week, as well as a holiday week bereft of liquidity where big reversals in trends are unlikely unless something really out there happens. But nevertheless, the sustainability of this optimism to something that is more so rooted in the kind of thing that lifts stocks longer term, the prospect of higher earnings, say, the prospect of more consumer spending, the prospect of better growth. That is pointedly not here. Now, as far as a catalyst for a turn, things get increasingly worrying when we consider the credit situation in markets come next year. So if we look here, we notice, of course, in the gray bars here is the average 10-year bond yield. And not surprisingly, it has pointedly increased with central bank efforts, and also, of course, with the recovery from the depths of COVID as capital moved out of bonds and into riskier assets with initial signs of recovery. And so yields started to rise only because risk appetite improved. And then, of course, come the beginning of last year, you really get this much more spirited advance. You can see the gray bars really start to race higher with the beginning of the rate hike cycle. What's key here is that global inflation expectations, that's the red bar there, they don't begin to come down until almost a year later off the bottom in yields. If we look at the absolute bottom, and it's a little bit unfair because, again, this is the depths of COVID being unwound, then we're looking at 2 years. If we look at the start of the rate hike cycle, which is right around here, you can see the top in inflation expectations doesn't happen for at least half a year or so after. the top in global inflation, you can see here it's lagged 6 months, is another year after that. So 6 months after the peak in expectations and close to a year after the start of rate hikes. The worrying part here is, of course, financing costs are now at their cycle highs. Inflation is still relatively elevated at close to 6%, even though it's falling, and inflation expectations have stopped improving. So how long higher for longer looks like is not looking very encouraging for a quick, rapid move to ease interest rates. Not surprisingly, again, the Fed is seen doing something toward the end of the first half. It's much the same story with the ECB. It's going to take even longer, it looks like, with the Bank of England. So we're going to have high interest rates for a while next year. Meanwhile, the debt burden has increased astronomically. So we can see here that during the period when inflation was peaking, not surprisingly, the percent of GDP that is debt came down quite a bit, from about 360%, which is tough to even get your mind around, down to about 335-ish percent, but it has since started to rise again. This is data from the International Institute of Finance. While the overall stock of global debt has increased to $310 trillion, which is absolutely huge. The average maturity on this debt is about 4 years across public, private, and other entities. So there is a wall of debt next year that will need to get refinanced at much, much higher interest rates. And there is a huge pile of it. And the likelihood that some of it can't be repaid or can't be refinanced seems significant. Now, when that occurs, there's going to have to be a rush for cash to pay that down. Now, how do you get that cash? Well, ostensibly, you sell assets, which, of course, is the thing that is the least nailed down. It's difficult to sell factories. It's difficult to sell houses. It's easy to sell stocks. It's easy to sell other financial assets. Easier, certainly. And so as all of this debt comes together and needs to be refinanced next year, we might well see all kinds of reasons for stocks to come down, if only because people need to raise cash to make these payments. And with inflation coming down, the debt to GDP ratio has started to perk up again. Because, of course, debt in real terms becomes cheaper if inflation is higher. If you have to take your nominal debt load and subtract from it a larger inflation component to see what you're actually paying in real terms, the higher the inflation, the less you're paying in terms of real purchasing power. Well, the Fed's efforts and other central banks' efforts to beat inflation has meant that that dilution of debt has slowed. And so now you have to pay more. And with GDP stalling and perhaps shrinking, with everybody seemingly walking hand in hand into a global recession, the denominator of this thing is going to go the wrong way too. That, of course, means still more debt that needs to be refinanced and more crowding of spending on debt servicing rather than other things. That looks like a vicious cycle. That's bad for growth and feeds onto itself. If we look at the schedule of corporate debt maturities, it only gets bigger over the coming years. Now, in fairness, the majority of it is investment grade, so these are good borrowers. But there's certainly plenty here to be an issue. Total debt rollover for this year was about $2.2 trillion. Next year, it's 2.3. In 2025, it's a little bit over that. In 2026, it's a little bit over that. This is data from S&P Global. So the problem only compounds over time. U.S. consumers are, in fact, feeling the pain already, it would seem, because loan delinquencies are on the rise. Overall consumer loan delinquencies we can see here through July, they're up to the highest levels since before COVID. Credit card delinquencies, we have more current data for. That's through October. And we can see here the highest rates since about mid-2020, both on short term, 30 days, and longer term, 90 days. So there is already a creaking under the weight of debt that is on display. As corporates and sovereigns join this party next year, the hit to growth, the need for cash, is likely to bode ill for risky assets, and is likely to bode well for the U.S. dollar because that is indeed the cash upon which a premium there will be. And so, as we look at the current environment and things look rosy, and indeed I am participating in them as such, it looks important not to over-extrapolate and to treat this as a bit of relief before a larger issue, rather than the makings of a generally positive time in the markets for risky assets as the calendar turns to next year. And that is macro money for today and for this week. We're here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happens on Wall Street on a given day and what it might mean going forward. Back on with Chris tomorrow, as I am every Friday, for Futures Power Hour. On with Tom and Tony for First Call on Sunday. And writing for the news and insights section of tastylive.com. I'm also sporadically opining on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Macro Money will be back for an abridged week next week because of the holiday, but we are back on Monday. In the meantime, good luck trading out there. Take care.